There's a lot of hullabaloo, let's say, about the Federal Reserve, and there's nothing that's untrue about that hullabaloo on January 4th that wasn't true on December 29th, let's say. And so I think from an investment standpoint, the calendar turn is not unimportant because there are some flow and positioning reasons why it matters. But from a narrative, from a broader market and economic perspective, nothing's different next year. The trend is still the trend, and that remains in place.
There's no doubt the trend is clear, and it's sort of, got to prove itself that it's turned. You can't just anticipate it. But the levels are different. The valuations are somewhat different. The embedded assumptions about what the economy can deliver, in theory, have changed to a fair degree. Just how much, I guess.
Yeah, but I mean, next year that unfolding story remains in place. And so, again, to the turn of the calendar, we're still left with the same unknowns on January 1st that we have on December 31st. How far is the Fed going to ultimately go? And while inflation is coming down, this is the easy part, so to speak. Are they able to get down to 4 to 3 to 2? And that conversation obviously is a story for the new year.
And you expect that it'll be sticky at some point on the way down?
Yeah, listen, we've been... listen, this is a very complicated and long conversation. I think there's a lot of people who talk about, well, inflation is coming down. Look at oil prices, look at lumber prices, look at the commodity indices more generally. Those are the goods prices. I know I'm not telling you anything you don't know, but for the viewers, that's the goods prices portion of the conversation. We know that's going to come down, has been coming down, and should continue doing so. The second part of the conversation is that labor market part of the conversation. Once the goods prices stuff have come down and you've gotten rid of we'll call it the excess fat from the inflation part of the conversation, can you get down back to the 2% target? And the Fed believes, it doesn't matter what I think, it doesn't matter what you think as a viewer, the Fed thinks that they cannot, in a sustained and perpetual way, get back down to 2% without curbing some of the excesses in the labor market. And like anything else, that's a story for 2023 and what ultimately that means for the economy and markets.
Yeah, which gets right to, we've been talking all day about what David Tepper had to say about, the Fed told you what it's going to do. Why don't you believe them? And of course, that, in a don't overthink it kind of way makes the most sense. On the other hand, in August of 2021, right, at Jackson Hole, they were saying we're not even prepared to slow down the asset purchases in QE. We still think the risk is we're not going to get to our employment goals. And 8 months later, they're initiating the most rapid tightening cycle in decades.
That's right.
So at some point, events and the cycle kind of overtakes their intentions.
Sure, and listen, I'm going to make a very dramatic statement here. No one's going to agree with me. The Fed doesn't always get it right.
Yeah.
And I think when you look at the pricing in markets, to Tepper's point, I watched the video, obviously, to Tepper's point about the markets don't believe the Fed, the Fed's trying to do two things, obviously, bring inflation down and bring asset prices. They're doing a lot of things. But the point of the story is what markets don't believe is that once you see the weaknesses, it's easy to talk. It's sort of a variation of the everyone's got the Mike Tyson comment, everyone's got a plan until you get punched in the face.
Yeah.
It's easy to say you don't care that inflation's your priority once people start losing their jobs, which presumably is going to start happening to some degree in the second or third quarter of next year. It's going to be a lot harder for the Fed to stick to their guns, and what the market is betting on is that the Fed is ultimately going to blink. Whether that's true or not remains to be seen, but I think that explains a lot of the mispricings, if you will. And
you don't even have to necessarily say that the market is explicitly countering what the Fed is intending to do. What the market has to do...
Although it is.
Well, yes. Certainly there's a contrast there. But what the market really is doing is trying to encompass a range of probabilities, which could include a really hard landing and something that forces the Fed's hand, or something that looks really deflationary on the way to, to where they want to get.
And I think that's right. And if you look at the Fed Fund futures market, for instance, which isn't the most liquid of all you could do, the Eurodollar market, but for the viewer, if you look at the Fed Fund futures market, they don't even have rates getting to 5%. And as everyone has observed a zillion times over, basically everybody in the FOMC thinks you're going north of 5%. Exactly, yeah. So as a microcosm of the mispricing or the disbelief in markets, look no further than that. But again, it is a legitimate worry for various markets when unemployment, presumably it does, starts weakening, and you're not creating 200,000-300,000 jobs, but you're creating 50 or 75,000 jobs, and jobless claims are not measured in the low 100,000s, but 100,000 or 200,000 more.
Yeah.
is the Fed going to be as robustly hawkish on the inflation front as they are now? That, by the middle of the year, will become clear. But in terms of the mispricing in markets, I understand it. I mean, we're as uncertain now as we've been in 40 years. And again, like anything else, it's why the bias in markets is probably to the downside still.